rates. All right. So these are the guys that come up with the different rates, the interest rates, lending rates, all that. All right. So it's the banks that that make up this market. Okay. Okay. They like 80% of this comes from these guys. So as an individual trader, you're only contributing 20%. All right. So question is, remember we talked of 6.6 trillion. All right. So the question is, if you're only contributing 20%, only 20% of this, you're safer. Which side would you rather trade with? The individuals or the big guys? We are safer trading with the big guys. All right. Because once these guys make a move, now, like for example, you're looking at this chart right here. If you're doing over 6.6 trillion, you can go to your calculator and check that out. 6.6 trillion. If you take 80% of that, let me see how much that would be. 6.6, 80%. That's about 5.2. 5.28. $5.28 trillion. Now, the balance is, let me see, 1 point. This is 1 point, 1.32. 1.32. So definitely, if this was to be, those scales that kids like to play with, definitely the individuals are always here. That means they are programmed to lose. And the banks are ever winning. So you're safer trading with these banks, and that's what we call institutional trading. All right. And that's what we are going to look at in this course. Because if you're opening up an account with your broker will tell you that 90% of individual traders lose money. So the question is, why are they still trading if they are losing money? Meaning that, yes, they are doing it, they love it, but they're doing it the wrong way. Okay? Yeah, so we are going to learn how to take advantage of the big guys, learn where their trades are, where their entries are, where their like possible trades are, and we leverage on that so that we are able to be profitable consistently in this market. Okay. So if I may just give another example. For example, if let me see. You remember when the Queen died? Okay. Do we all? Well, I'm sure we're all aware of that. Let me look at the GBP, JPY. Let me see. I like to give this example. I don't know which time. When did the Queen die? It was around. Dennis.
Yes, Cliff.
Do you remember when the Queen passed?
I think it was around 2021 when JPY sold for a very long.
It was 2022.
2022
around September.
Yeah.
So you see this big wick right here. This whole thing. All this. The moment she passed away, and that affected the market. Okay. Remember, we are now talking about the government, politics, and all that. The moment she passed away, it affected the market for all these pips. Let me see how many pips these are. No worry, we are going to look at pips and get to know what pips are. That's about 600 pips. All right. So if you are putting $1 per pip, that's about $600. And that's a lot of money. Not only on this pair right here, there are so many other pairs. There is the Euro GBP was affected. All GBP pairs were affected. simply because she passed away. But remember, sorry, notice this. When you move in front, the market literally came back to that same area to give us our move that we were looking for. So these guys had already marked that price. They had pending orders right there. So when the market was buying, it was buying only to come back and pick up these orders, these bank orders that some banks and big guys had already booked before it could push up. So these are the things we need to learn to identify in the market and know when. For example, you may be also trading now, like, let's go to the daily chart. You may be trading and you see a big push to the downside. Let's put it on the 1 hour chart. We don't usually look at that, but for this example, you see such big candles, all this. This is all news coming through, right? So you see such big volatile moments. Now you see this long candle right here. Let me zoom in. I hope we can all see it. This candle right here. All this. Realize that's like an impact caused by a particular announcement that has been made by some influential guys, the likes of Powell and all that. So that's called fundamental trading if you're looking at the fundamentals, but here we are going to mainly go by the technicals. Does anyone have questions on what I've gone through so far before I proceed? Or do you prefer we have a Q&A at the end of the session?
A Q&A will be good, so that
okay, that's fine.
And if anybody has a question also, they can ask.
That's fine. You know my style, I like to have a discussion kind of thing. Huh? Okay. All right. So let's proceed. So there are different ways that we analyze this market, and analysis is made on what we call a chart. Okay. This is a chart. Let's open this a fresh one. This is a chart right here. Okay. We call this a chart, and we use it to analyze the market. And basically, what analysis is all about is using the past to predict the future. Okay, as you can see, it goes way back to, let me see how far this goes. This goes way back to 2016. Well, actually, it's still, let's see how far this goes. It should be 2006 or something. Yeah, 2006. So we can literally see data from 2006 all the way to the current data on this particular pair and broker, because this is forex.com. And I hope we all know how to use TradingView. If you don't know how to use TradingView, please send that in the group so that we have a different session for that.
So, Cliff, none of your students, apart from me, knows how to use TradingView. They are all new.
Okay, that's fine. So that means we are going to have a session and we learn how to use TradingView and MT4 and MT5. Okay, so that will be in our next session. Hopefully, we finish up this theory bit. Oh, okay, that's good. Thanks for bringing that out up. Huh? I wanted to be sure. I may be talking, thinking that everyone is on the same page with me. Okay, that's good. So, as you can see, this data goes all the way to 2006. So we use that to analyze and predict what's going to happen today. All right. So we rely on history. We rely on history to predict what's going to happen. Now, like for example, right now where the market is, we can clearly see that whenever this market came to this price right here, it was buying. From this point, the market bought. Okay? Came back again and bought. Right now, it's at the same area. So there we simply have to draw our trend line and wait. The moment we get our confirmations, we know that this market is definitely going to what? To buy. But we already know we have our first clue. All these catches. Clue number one. This is demand. We call this demand. We are going to look at that as we move on. Okay. So there are three different types of charts that we use to analyze this market. The first one is the line charts. There is the bar charts, and there is the candlestick. Globally, the candlestick chart is the most widely used chart for analysis. There is even a whole Bible on this. It's called the Candlestick Bible. I think that's the Japanese way of trading. So, if you want to go so deep into that, you can. It's online. You can download that. If I get it, I'll post it on the group for those who are interested in learning all those patterns. So, this is the what? The candlestick chart. These are the candlesticks. We call them candlesticks. Each of these that you're seeing, this is a candlestick, that is a candlestick, and so on. All these are candlesticks. And they are communicating different things. As you can see, this one is long, is big with a long tail. Because a candlestick has two things, the body and the tail, right? That's the next slide that you're going to look at. But you see this one has a very short tail. This one has no tail whatsoever. Very tiny things, all right? So we are going to be looking at all that and see how to read this candlestick. So this is called the candlestick chart, where I use the candlesticks to tell and see what is going on in the market. Candlesticks are in different colors. By default, they may come in green and red, or black and white. Now, like for example, if you're using the phone, most of them will be in black and white, okay? But now mine, I use mainly black and white. Oh, I can choose to make it black completely, all right? Then number two, we have the bar charts. Yeah, the bars. They look like this, very confusing. There are things that I don't even look at, but some prefer this. If some feel like this is easier for them to read, and they use that for their trading. Then number three is the line chart. This is it. This is the line chart right here. And I hope we are all taking notes. 90% of our time we are going to be trading using the line charts. 90% line charts. The other 10% will be looking at the candlesticks. Because as we move on, you'll notice that these candlesticks are a bit confusing. They can mislead if you don't know how to really read them and interpret them. So, and another thing is, banks are only going to trade using true price only once the true price has been triggered. That's when a bank entry will be triggered. All right, because they are buying. Actually, everything you're seeing here is related to a particular price. Yes, we have this all this going on. By the end of the day, that is showing us price. All that is price. Because right now you can see that the market closed at 179.538. All right. And it had gone all the way to 188. Okay. And we know that this market is buying. So if you're buying this market, already you know that it's at 179.5. That means if you buy it at the right price, which we are looking at right now, you're going to make all this money. Okay? So analysis is important. That's how we are going to be trading. So there are three chart types that we looked at: candlesticks, bar charts, line chart. And we said 90% we'll be using the line chart to do our analysis. Then we bring in the candlestick just to have a few confirmations here and there. I hope that is clear. Then maybe just to throw more light on the thing of true price. Okay, let me first bring in the candlesticks, and I just give us an example. Okay, I think let me just cover that in the next. Just cover it right now. Okay. So this is what I mean by true price. Okay, a candle has three main things. There's the body, which is this whole thing. This is the body of the candle. Okay, that is the body. Let me put a B there. That's the body. Then this is called the wick. The wick or a tail. All right. Then these are the open and close prices. All right. So what do I mean by true price? True price is this one from the body of the candle. That is the true price. Everything to do with these wicks. Hold on. Everything to do with this, all this. This is, I call this manipulation. All this. This is where the broker has an opportunity to manipulate and do whatever they want. So if you're caught within these weeks, that's the time you'll be seeing big drawdowns coming in. But the moment you take price where it's supposed to be, because you notice that this candle opened from here, closed from there, and the next candle started right there before it went down. And you can see, even the next candle did the same thing. Even right here, the next candle did the same thing. All right? So this one, there was some sort of gap. But you can see that every time a candle closes, the next one opens from there. It closes, the next one opens from there. Now, when I bring in my line chart, let me first circle those areas for you to see. Let me just circle those wicks. I want you to see what happens. Okay? All these are wicks. Wherever I'm circling, those are wicks. So let's bring in our line chart and see how it looks. See that? When we bring in our line chart, all the wicks have been eliminated. We are only marking the true price in the market. That's what the line chart reads. Besides showing you the trend that is in the market, it's also giving you the true price. So meaning that if you enter from here, you've entered at the right price. That right there is the right price. Okay? So that's what I mean by true price. And that's why I love the line chart, because I'm trading where I'm supposed to trade from. Remember, we said we are trying to mimic the big guys and move with them. As you can see right now, right here is the lowest point that the market had gone, right there. Then there is this other one, right here, where price is right now. So price has sort of broken it, and it is coming to the low one. So I'll only think of selling this market once this price has been broken. But until then, this market is still in the buying zone. So this whole area is an area of demand. Once we start covering demand, we'll look at that in detail. Okay. All right. So let's look at the currency. pairs, and we understand what pairs and how do we read pairs. Okay, so first and foremost, what is a pair? A pair is an exchange rate for two different currencies. For example, in this example, we are looking at Euro USD, which is the euro, and the US dollar. So that means we are exchanging the euro for the dollar and the dollar for the euro. Okay, so we have close to 9 major currencies, which include the Canadian dollar, the GBP, euro, JPY, AUD, Australian dollar, NZD, and the Swiss franc. These are the 9, and the USD. These are the 9. Let me see, 1, 2, 3, 4, 5, 8. Okay, there is the Singapore dollar somewhere, which that one I rarely even look at it, but there are 9 of them. Okay, and you'll notice that all of these have a particular commodity attached to them. There's a particular commodity that is traded in that particular currency. So anything that happens to that commodity greatly affects that currency. For example, oil. If I choose to trade oil, that means I'll be trading the Canadian dollar. That's what I'm trying to explain here. If I'm to trade the Australian dollar, I'm literally trading gold, iron ore, and coal. Why? Why is that? Because you notice that you not see the Chinese currency, the yen. You won't see it anywhere. All right. So, but 60% of China's economy is translated through the Australian economy, because almost 60% of the exports are pushed through Australia, China's exports. Okay, almost 60% of that is pushed to Australia. So that means if anything happens to the Australian economy, China will be hit. All right, and we can have a live example on this, just a quick one. Let me see just example. Let's see Australian dollar, USD. I like giving this example. Oh, let me not mess up with our analysis. Okay, let's take it on the weekly chart. All right, I'm sure we all remember the time of COVID. COVID, that was around 2019. You see what happened to the market? This is what happened to the market. You see this whole week right here? Around 2019, there was somewhere around here when China closed their borders from this scandal. China closed their borders. There were no more exports from China because they were the first country to lock down. And you see, for 1, 2, 3 months, we are seeing this market push down. That's a very big push. Let's see how many pips these are. From here all the way, that's about 1,400 pips in 3 months. And that's a lot of pips for a currency. A currency to move that much, that's a lot. That's a lot. Yeah, so we saw that market drop for all those pips. And notice what happened. The moment China opens their borders, we are seeing the Australian dollar gain back its momentum. And what happened then? The US had also closed. The moment China opens, US closes. And we are seeing the same thing happen on the opposite side. Okay, so once you look, the moment you decide to trade the Australian economy, make sure you're keeping tabs with the Chinese economy as well. All right, and we all know gold is largely traded in the Australian dollar. If we didn't, we need to do some research on that. Why did I bring in iron ore and coal? China exports 50% of the world's steel. 50% of the entire steel in the whole world comes from China alone to the rest of the countries. So you already know what is going on. Okay. Then when you're looking at the New Zealand dollar, that's mainly the farm products. Okay. Yeah. So back to our currencies, our currency pairs. A currency always has two things. There's the base currency and the quote currency. In this case, we have the Euro USD. The base currency is always the strongest currency in the pair, or the one that largely affects the other pair. In this case, the euro is stronger than the US dollar. So definitely, that would be the currency. If you were to look at the Ghana currency, the Ghana cedis, and the dollar, it will be USD, USD, something like that. If I'm getting it right, okay? Because the USD is bigger than the Ghana currency, the Ghana shillings, okay? Nope, I don't know if you call it shillings. Maybe they are cedis, I think. So if you look at the Ugandan economy now, like in my case, against the dollar, it's USD, UGX. Okay. If you're looking at the GBP and the dollar, the GBP, the pound is stronger than the dollar. So definitely it will be GBP, USD. So we need to know all these things, and they will help us as we move on with our trading. Yeah. So in brief, that's it. Maybe and one that I need to share more light on is the Australian dollar versus the USD. The dollar, the USD is bigger than the Australian dollar, but it so happens that the Australian dollar is the best currency. Now, like in this case, AUD, USD, which shouldn't be the case. Otherwise, on our scale, we should have been having a 1 point something, 1 point, 1 point something. But now we have 0 point. Shouldn't be like that. But remember what we talked about, the commodities. I mentioned something about the commodities that affect such currencies. This one, there's a lot of trading that is going on in the Australian economy, which makes it strong. And most of these exchanges, there are many exchanges in Australia alone. Those are things that have made it of great influence. So it greatly influences the US dollar. All right. I hope that one is clear. If not, kindly make a note on that. We shall I'll visit that during our Q&A. So every pair has what we call a bidding price and a selling price. Bidding price is the buying price, and the ask is the selling price. Okay? And there must be a difference between those two, what we call the spread. That's what we call the spread or the gap. So this will help you find a good broker. If you have a terrible broker, you'll be making losses. For example, in this case, you see there is a 0 and there is a 1. So the difference there is 1. That means there's a spread of 1 point or 1 pip. Okay? In a scenario where you have 10 pips as a spread, that means you're losing 10 pips per move that pair is making. Take note of that. let me just, I like to be practical in this thing. Let's look at it. Let's look at it. Let me go to the 1 minute chart. Okay. Move it. Okay. Leave it like this. We'll put it on the 1 hour. All right, that is it. So do you see this? There's the ask price and there is the bid price right there. When you look at it closely, there is a difference because this is 1 0 and this is 0 7. That means there's a difference of 3 pips on this pair. So if you're staking $10 per pip, that means already you're in a negative $30 just at entry on this alone before the market even starts moving. So you need to be careful on the brokers that you're using. There are some brokers who give you terrible spreads. And you realize that you're losing money. Drawdowns are huge. You're losing money on drawdowns alone, yet the market is coming back to pay you. So you need to take note on all that, all right? And so I've been mentioning other things like pips. So I'm sure some.
Sorry, let me ask a question. Sorry. Can I ask a question, please?
Please.
Yeah, how do you know if you have the right broker?
Okay, now there is what we call a demo account, okay? Every time you sign up with a particular broker, you need to open up a demo account. First of all, you know if they are regulated or not, because already we have all that information. We shall recommend. There are some brokers that we've been working with, shall recommend, okay? But that aside, you need to open up a demo account firstly before you go live. Open up a demo and test all these things. Now, like Dennis, if I may tell you this, there are some brokers that we signed up with, but I noticed that they are not good. For example, they are terrible on indices. All right.
Which one?
Xness.
Xness. Oh yeah.
Yes. So terrible on indices and other pairs as well. Because I tried. There were some good moves on crypto, but we couldn't log them in. All right. So most of these things are. So all you do is you go through and back test, check what this broker is offering. See what they're offering on indices, what they're offering on pairs. Look at the commissions that they are charging you, all those things. Yeah. Especially because indices are so volatile. So those are the instruments that we're really interested in because in one day you can make $500 just on a very small move. $500, $1,000. Yeah. So we are going to recommend the best brokers, the ones we feel they are good. And yeah, just to make life easy for us. But for you to know this at the back of your mind, you need to back test all these things. These brokers, you see, look at the offers. The offers alone will tell you that this broker is good or not. There is a time I entered a trade on NASDAQ. NASDAQ, that's an index. And I noticed someone was making $1,000 and I just made $10 on the same move. So I was wondering, what am I doing wrong? Actually, I was making $100 and they were making 1,000 on the same move, but mine was a standard lot and his was 0.01. So I was wondering, what did I do wrong? You get it? So I lost out on all that money